Something has changed, and most people have not noticed it yet. That is how systems usually hurt ordinary people. They do not announce the change with a loud bell. They do not send a warning to every household. They shift quietly, one rule, one form, one software update, one compliance memo at a time. Over the last 24 months, the rules around the $10,000 bank reporting threshold have been changed, widened, and enforced in ways that make it harder, riskier, and more expensive for an ordinary retiree to move his or her own money. That is the important point. This is not about a rule that might appear someday. This is about a rule environment that already exists. It is operating now inside bank branches, payment apps, crypto exchanges, car dealerships, contractor offices, law firms, and government databases. Most Americans over the age of 60 still think the $10,000 rule is the same rule they heard about years ago. They think it is about criminals carrying bags of cash. They think it is about drug dealers, money laundering, or people trying to hide illegal income. That is an old picture of the system. The new system is much broader. It catches ordinary behavior. It catches retirees buying cars. It catches people helping children with down payments. It catches homeowners paying contractors. It catches grandparents moving money between accounts. It catches digital payments that feel harmless because they happen on a phone. And if you do not understand the system, you can make a completely legal decision with your own money and still end up frozen, flagged, reported, delayed, or forced to explain yourself to people who do not know you. I want to walk through this the way I look at all systems first. You have to understand the machine. Then you have to understand the incentives inside the machine. Then you have to make decisions that reduce your risk without doing anything foolish. Emotional or reactive. There are 5 changes that matter most. One of them can delay a withdrawal for up to 72 hours before you ever touch a dollar of your own money, even if you are mentally sharp, even if you have been with the bank for decades, and even if the transaction is perfectly ordinary. Another can turn a series of smaller deposits or withdrawals into something that looks like a federal structuring violation, even when every dollar is clean and every motive is innocent. Another pulls crypto, Zelle, Venmo, Cash App, PayPal, and other digital payment channels into a reporting world that most retirees still associate only with cash. Another makes businesses that receive meaningful cash payments from you much more likely to file reports because their own penalties have increased. And the last one is not a new rule at all. It is the frozen $10,000 number itself. That number has been sitting there since 1970. While the value of money has changed dramatically, that frozen number is the root cause. It is what makes a rule designed for large, suspicious cash activity collide with the normal financial life of a retired American family. Before I explain the 5 changes, I want you to understand a simple story because stories often show the system better than definitions do. Imagine a retired couple. I will call them Martin and Carol. Martin is 71, Carol is 68. They live outside Phoenix. Martin worked for almost 40 years in a regional business. Carol worked for decades as a nurse. They are not rich in the way people use that word on television. They are comfortable, they saved, they planned, they did the responsible things. Last October, they decided to replace Carol's car. They did not want a loan. They did not want a monthly payment. They had the money. They negotiated the price down to a little over $40,000 and decided to pay cash. In their minds, that was conservative behavior. Martin went to the bank the next morning. He filled out the withdrawal slip. He expected to sit for a few minutes, sign something, and leave with the cash. Instead, the branch manager came out and asked him to step into a private office. The question started. Why do you need this much cash? Did anyone tell you to make this withdrawal? Have you received any phone calls, emails, or text messages asking you to send money? Have you met someone online? Is someone pressuring you? Do you understand what you are doing? Think about what that feels like when you are 71 years old, have saved responsibly your whole life, and are simply trying to buy a car for your wife. Martin was not confused. He was not being scammed. He was not trying to hide anything. He was a competent retired man trying to use his own money. But the bank did not see a husband buying a car. The bank saw a senior customer making an unusual cash withdrawal far outside his normal pattern. The bank saw liability. The bank saw regulatory risk. The bank saw a possible elder exploitation event. And when a bank is forced to choose between releasing money and possibly being blamed later, or delaying money and being protected, the incentive is clear. Freeze first. Apologize later. After Martin explained the dealership, the purchase, and the reason for the cash, the bank still delayed the withdrawal for 72 hours. He had to go back to the dealer and ask them to hold the car. He eventually got the cash. He thought that was the end of the problem. It was not. A suspicious activity report was filed. That report went into a federal database. It can remain there for years, and it can be compared against future transactions. Martin did nothing wrong, but now his transaction pattern had become part of a government risk file. That is what makes this issue important. In life and investing, I try not to focus only on one event. I look at the pattern that produces the event. Martin and Carol's experience was not just bad luck. It was the predictable result of a system whose incentives have changed. To understand why, you have to go back to the number itself. The $10,000 reporting threshold was created under the Bank Secrecy Act of 1970 that matters. Because 1970 was a completely different monetary world. A gallon of gas cost a fraction of what it costs. Now a new home costs a small fraction of what a home costs today. $10,000 could buy serious assets. It could buy a meaningful portion of a house, or more than one new car for many households. It represented more than a full year of income. In 1970, $10,000 was a very large cash movement. Today, $10,000 is not small, but it is no longer rare. It can be a used car, it can be part of a kitchen remodel, it can be a medical bill, it can be a dental procedure, it can be a roof repair, it can be a family gift, it can be a lump sum retirement distribution, it can be a contractor payment, it can be the ordinary financial life of a retiree. If the threshold had been indexed to inflation, it would be many times higher today. It would not be catching the same people, it would be aimed closer to the kind of unusually large transaction it was originally designed to catch. But the number was not indexed. The rule stayed still while prices moved. That is how systems become dangerous. Without anyone passing one dramatic new law, inflation moves the world. The frozen threshold stays in place. Over time, normal people are pushed into a compliance system that was not originally aimed at normal behavior. That is why a rule that once caught suspicious cash movements now catches grandparents. That is the baseline. Now let me explain what changed around that baseline. The first change is the senior withdrawal freeze. This is the change that caught Martin and Carol, and it is the one most retirees do not know exists until they collide with it. Banks are under more pressure to detect elder financial exploitation. That goal sounds good, and in some cases it is good. Elder fraud is real. People do get scammed. Banks do sometimes prevent terrible losses, but every protection system creates a new risk when it is built around fear, software, and legal immunity. When a bank sees a senior customer trying to withdraw money in a way that does not match the past pattern, the bank may delay that transaction while it reviews whether exploitation might be involved. The key phrase is not proof. The key phrase is suspicion. Suspicion can be created by a sudden larger withdrawal. Suspicion can be created by a transaction that does not match what you usually do. Suspicion can be created because a software system has decided that your pattern changed too quickly. This is where people misunderstand the process. A bank does not need to know that someone is scamming you before it delays the transaction. The bank only needs enough concern to justify review. Once that review starts, the time belongs to the bank, not to you. If you have spent years withdrawing a few $100s at a time, and one day you ask for $12,000 or $40,000, you may know exactly why you need it. The bank's system does not know. It sees deviation. Deviation creates a flag. A flag creates a review creates delay. And because many state laws give banks protection when they delay transactions they suspect may involve exploitation, the bank's risk is asymmetric. If the bank releases money and the customer later claims fraud, the bank may be blamed. If the bank delays money and the customer is merely inconvenienced, the bank is usually protected. When incentives are asymmetric, behavior follows. That is a principle you can see in markets, governments, companies, and banking. People and institutions respond to incentives. The bank is not trying to insult you. It is trying to protect itself, but from your side, the result can still be painful. A car can be lost. A contractor can walk away. A medical bill can sit unpaid. A family emergency can become more stressful. And the most uncomfortable part is that the bank may not have to give you a clear explanation in the moment. You may hear processing issue. You may hear compliance review. You may hear nothing specific. What you will know is that your money is not moving when you expected it to move. That is the first change. The second change is the structuring trap. This is the one that I think is most dangerous because many honest people can create the pattern without understanding what the pattern means to the government. Structuring means breaking deposits or withdrawals into smaller amounts for the purpose of avoiding a reporting threshold. That sounds like something only a criminal would do, but ordinary people do it all the time because they think they are being prudent. A retiree may say, I do not want to make the bank nervous, so I will deposit $8,000 this week and $8,000 next week. A small business owner may say, I do not like paperwork, so I will keep each deposit under $10,000. A family may say, we will split this payment into pieces so it does not create a report. That thinking is exactly the problem. The report itself is not the danger. The attempt to avoid the report is the danger. The money can be clean, the reason can be innocent, the source can be completely legitimate. It can be savings, a home sale, an inheritance, a pension distribution, an insurance settlement, or the proceeds from selling personal property. If the pattern looks like it was designed to avoid reporting, you have moved from a simple reportable transaction into a much more serious problem for many years. The patterns that created obvious risk were very close to the threshold. Deposits of $9,500, withdrawals of $9,800, repeated transactions just under $10,000. Those were easy to identify. Now software is better. Pattern detection is broader. Banks do not need to wait for the obvious case. repeated activity at $7,000, $8,000, or $8,500 can also raise questions if the timing and pattern suggest an effort to stay below the line. That does not mean every such transaction becomes a criminal case, most do not. But being flagged is not nothing. A flag can create human review. Human review can create a suspicious activity report. A suspicious activity report can sit in a database. That database can be cross-referenced. In some cases, the issue can move toward an IRS or law enforcement inquiry. In some cases, civil asset forfeiture can become a risk. The lesson is simple, but many people resist it because it feels backward. If you need to move $12,000 for a legitimate reason, moving $12,000 as one clean transaction is often much safer than moving $6,000 twice for the purpose of staying under the threshold. The system punishes the concealment pattern, not the size alone. That is why I call it a trap. People think smaller transactions look safer. In the wrong pattern, they look worse. There have been many documented cases of people whose accounts were seized under structuring theories even when they were not charged with crimes. Some were business owners, some were farmers, some were store operators, some were families handling ordinary cash flows. The facts vary, but the pattern is similar. Legal money moved in a way that matched the government's structuring model, and the burden of getting the money back became long, expensive, and frightening. That is how a rule meant to catch evasion can punish people who were trying to avoid trouble. The third change is that digital money is now being pulled into the same broad reporting environment. This is where many older Americans are behind the system because they still think of banking rules as cash rules. They think, if I did not walk into a bank with cash, this is different. That distinction is disappearing. Crypto exchanges, peer-to-peer payment apps, digital payment platforms, and traditional banks are becoming part of one increasingly connected reporting ecosystem. Zelle, Venmo, Cash App, PayPal, crypto exchanges, and bank accounts may feel different to the user. But to regulators, they are all ways money moves through the system. When a system becomes more digital, it also becomes more trackable. That is the trade-off. Digital payment tools are convenient, they are fast, they reduce friction, but they also produce records, forms, thresholds, matching systems, and tax questions that many people do not understand until after the form arrives. A small payment from a neighbor may be harmless. A reimbursement from a family member may be harmless. A transfer from a child may be harmless. But if digital accounts mix personal reimbursements, casual sales, side income, family gifts, and business activity, the reporting picture can become messy very quickly. That is especially true as reporting thresholds fall. A retired person who sells a used item, receives family reimbursements, helps organize a church event, or gets paid back by friends can accidentally create a reporting record that looks like income unless it is documented and separated properly. This is not because the person did anything wrong. It is because the system does not understand context unless you create records that show context. That is a recurring principle. The system sees numbers before it sees explanations. If the number crosses a threshold, the system may create a form. If the form does not match your tax return, the system may generate a question. If you cannot explain the question clearly, the problem becomes larger than it needed to be. For crypto, the same logic applies with even more complexity. Transactions that people once thought were private, informal, or outside the old banking world are now increasingly connected to tax forms and reporting channels. That does not mean people should panic. It means they should stop pretending that digital money exists outside the system. It does not. The fourth change is the pressure on businesses to report transactions involving you. Many people focus only on what the bank files. They forget that the person or business receiving the money may also have a filing duty. When a business receives more than $10,000 in cash or certain cash, like instruments from a customer, it may be required to file Form 8300 with the government. That form identifies the payer, the amount, and the nature of the transaction. This applies to many ordinary transactions: a car dealer, a contractor, a lawyer, a jeweler, a boat dealer, a real estate-related business. A business that receives meaningful payments in forms that trigger the rule. The penalties for failing to file correctly or on time have increased. That changes the incentive for the business. If a contractor receives a payment from you and is unsure whether it needs to file, the safer choice for the contractor is to file. If a dealer receives cash from you, the safer choice is to file. If a lawyer receives a large retainer in a reportable form, the safer choice is to file. Again, incentives drive behavior. The business does not want to become the target of penalties because it failed to report your transaction. So it reports. That means a transaction you think of as private, ordinary, and local can become part of a federal reporting record. And here is the part that catches many people: related transactions can be aggregated. If you pay $6,000 now and $6,000 later for the same roof job, that may still be treated as a $12,000 related transaction. Splitting the payment does not necessarily avoid the reporting duty. In fact, if the split was done to avoid reporting, it can create a worse pattern. That is why the instinct to break transactions into pieces is so dangerous. It feels safe to people who do not understand the system. It looks suspicious to the system itself. The fifth change is the inflation cascade. This is not a formal rule change. It is more powerful than a rule change because it happens every year without debate. Prices go up. The threshold stays the same. The gap widens. More ordinary transactions cross the line. More forms get filed. More reviews get triggered. More people appear in databases. More retirees get surprised. Think about what a normal retiree may do in a single year: a car purchase, a home improvement, a medical expense, a dental procedure, a gift to a child or grandchild, a funeral expense, a settlement payment, a pension distribution, a required minimum distribution, a sale of property, a transfer between accounts, a mortgage payoff, a tax refund, an insurance payout, a repair after storm damage. Many of these can cross $10,000 today. None of them requires criminal intent. None of them is strange. They are normal life events. But a frozen threshold turns normal life into repeated reporting events. That is why the problem is getting worse, even if Congress does nothing. The system becomes more sensitive because money loses purchasing power. A threshold that does not adjust becomes tighter in real terms every year. This is how people get trapped by old rules in a new economy. Those are the 5 changes. Now I want to focus on what to do, because fear without action is not useful. A good principle is to convert risk into a checklist. When you can name the risk, understand the mechanism, and build a habit around it, the risk becomes manageable. The first protection move is to pre-notify your bank before any meaningful transaction. This is simple and it matters. If you are planning to withdraw, deposit, or transfer a large amount, especially if it is outside your normal pattern, call the bank before the transaction, speak with the branch manager or the relevant banking officer. Explain the purpose. Ask them to note the account. Ask what documents they want. Ask how long the transaction will take. Ask whether there is any elder fraud review process that could delay it. Do this before the day you need the money. The goal is not to avoid a required report. Do not try to avoid the report. The goal is to avoid surprise, delay, and confusion. When the transaction hits the system, the note in your file can make a large difference. A human reviewer can see that the customer called in advance, explained the car purchase, identified the dealership, and provided context that does not eliminate every report, and it should not, but it can reduce the chance that your money is frozen at the worst moment. This is how good decision-making works. You do not fight the system emotionally. You understand its rules and reduce friction before friction becomes a crisis. The second protection move is to stop accidentally structuring. This is probably the most important behavioral change. Do not break up a transaction for the purpose of staying below $10,000. If you need to move $12,000, move $12,000 in a clean, documented, direct way. If you need to pay a contractor $14,000, do not split it into 2 payments simply because you want to avoid a form. If you have a legitimate business reason for staged payments, document that reason. For example, one payment may be a deposit and another may be due after work is completed. That is a business purpose. But the purpose should not be avoiding a federal threshold. The report is usually not your problem. The pattern of avoiding the report can become your problem. That distinction matters. A reportable transaction is ordinary. A structuring pattern is not. One is the system doing what it does. The other can look like you are trying to defeat the system. The third protection move is to use wires or other clean institutional payment channels for large transactions instead of physical cash whenever possible. Cash creates more friction. Cash creates more questions. Cash creates more security risk. Cash creates more Form 8300 issues for the receiver. If you are buying a car, paying a contractor, moving money to a title company, helping a child with a down payment, or handling a meaningful expense, ask whether a wire transfer is acceptable. In many cases, it is preferred. It creates a direct record. It reduces ambiguity. It reduces the chance that a large physical withdrawal triggers a senior freeze. This does not mean wires are invisible. They are not. It means they often fit the system better than carrying large amounts of cash. A principle I use in many areas is this: when you cannot avoid a system, move through it in the cleanest, most documented, least ambiguous way. For large transactions, cash is often the most ambiguous method. A direct wire with records is often cleaner. The fourth protection move is to separate digital payment accounts by purpose. Do not use one digital wallet for everything if everything includes personal reimbursements, family transfers, small sales, and side income. The system may not understand the difference. You should understand the difference. Keep personal reimbursements separate from anything that might be income. Keep hobby sales separate from family payments. Keep business-like activity separate from personal activity. The more mixed the account, the more confusing the record becomes. At tax time, confusion becomes expensive. It forces you or your preparer to reconstruct what happened. It increases the chance that a form reports a number that does not match the economic reality. It increases the chance that you miss something or report something poorly. A clean system is easier to defend. That is true in investing. It is true in business. It is true in personal finance. It is true in taxes. Do not wait until a form arrives to ask what the transactions were. Build the separation before the transactions happen. The fifth protection move is documentation. This is the least exciting move and one of the most powerful. For any transaction over a meaningful amount, write down the date, amount, source of funds, recipient, and purpose. Keep invoices, keep contracts, keep emails, keep sales agreements, keep settlement letters, keep bank confirmations, keep the car purchase order, keep the contractor estimate, keep the medical bill, keep the gift letter. The format does not have to be complicated. A spreadsheet is good, a folder is good, a notebook is better than nothing. The point is to create contemporaneous records. That means records made at the time, not explanations invented later when someone asks. When a reviewer looks at a transaction pattern, your records tell the story. Without records, the pattern tells the story for you. That is dangerous because patterns can be misread. Records give context, context reduces risk. This matters especially in structuring and forfeiture situations. If a person can show why deposits were made on certain dates, why payments were staged, why cash was held, why a withdrawal happened, and where the money went, that person is in a much stronger position than someone who says, "I do not remember, but it was innocent." I believe in radical truth and radical transparency in decision-making. In this context, that means creating a record that makes the truth easy to see. There is also an advanced move that many retirees should consider. Create a senior safe banking authorization or similar trusted contact arrangement with the bank. The name may vary by institution, the principle is the same. You want the bank to know in advance which types of transactions are normal for you, which trusted contact can be called if there is a concern, and which categories of expenses should not automatically be treated as suspicious just because they are large car purchases. Medical expenses, home repairs, family gifts, travel, property transactions, tax payments. If these are foreseeable, they should be discussed before a crisis. You do not want the first conversation about your financial pattern to happen while you are sitting in a branch office being questioned about your own withdrawal. Ask your bank what forms they have for senior customers, trusted contacts, elder fraud review, transaction authorization, or account notes. Ask who handles those forms. Ask whether you can pre-document common large transactions. Ask how the bank handles delays and who has authority to release funds. The goal is not to waive common sense protections if you are truly being scammed. You want someone to slow the process down. The goal is to prevent the bank from confusing your normal life with exploitation because you never gave the bank enough context. This would have helped Martin and Carol. If Martin S. Bank had already known that a car purchase was a normal and expected transaction category, if a trusted contact was already listed, if the account notes explained their pattern, the review might have been shorter or avoided altogether after their experience. They put that structure in place later. Large transactions move more smoothly. That is the lesson. Do not wait until the system has already labeled you. Build the context first. I want to be very clear about what I am not saying. I am not saying you should fear your bank. I am not saying you should avoid required reports. I am not saying you should hide money. I am not saying you should break rules. That kind of thinking creates exactly the problems we are trying to avoid. I am saying that the system has changed, and when systems change, old habits become risky. The habit of using cash for everything can become risky. The habit of splitting payments can become risky. The habit of mixing digital accounts can become risky. The habit of keeping no records can become risky. The habit of waiting until the last minute can become risky. Risk does not mean something bad will always happen. Risk means the consequences of being wrong are large enough that you should change your process. That is the way I think about markets, debt cycles, and life. You do not need perfect prediction. You need a good process that works across many possible outcomes. In this case, the process is not complicated. Notify the bank. Do not structure. Use clean payment channels, separate digital activity, document everything meaningful. Set up trusted contact and senior authorization systems before you need them. Those moves do not make you aggressive. They make you prepared. The retiree who gets hurt is usually not the person who was doing something clever. It is often the person who did not understand that the world changed. They move money the way their parents move money. They use cash because it feels simple. They split payments because it feels cautious. They ignore digital reporting because payment apps feel informal. They keep poor records because they assume common sense will be enough. But common sense is not always enough when a system is driven by thresholds, algorithms, legal immunity, government databases, and institutions trying to protect themselves. You have to understand the machine. Once you understand the machine, you do not need to panic. You just need to stop acting as if the old machine still exists. The $10,000 rule is not becoming simpler. It is not becoming more forgiving because people are older. It is not being adjusted to reflect what $10,000 means today. The enforcement environment is becoming broader, faster, more digital, and cheaper to operate. That is what happens when old thresholds meet modern software. The retiree who does nothing may be fine for a while. Most risks do not show up every day. But the problem appears at exactly the wrong moment. When a car is waiting, a medical bill is due. A contractor is scheduled, a child needs help, or a family emergency requires immediate action. That is when a 72-hour delay feels very different. That is when a suspicious activity report feels very different. That is when a frozen account feels very different. That is when poor records feel very different. I do not want you to learn the system after it has already acted on you. I want you to learn it before the next meaningful transaction. So look at your own life. Do you expect to buy a car? Do you expect to help a child or grandchild? Do you expect to pay a contractor? Do you expect medical expenses? Do you expect to sell property? Do you expect to receive an insurance payout? Do you expect to move retirement money? Do you expect to use Zelle, Venmo, Cash App, PayPal, or crypto platforms? If the answer is yes, then you are not outside this system, you are inside it. That does not mean you are in danger every day. It means the right time to build a process is now, not when you are standing at a teller window with a transaction already flagged. The most important thing is to remember the difference between ownership and access. You may own the money, but access to the money now passes through systems with rules, incentives, thresholds, and reviews. That is the modern reality. A wise person does not complain that the machine exists. A wise person learns how the machine works and reduces the chance of being damaged by it. Martin and Carol were not irresponsible. They were not criminals. They were not careless people. They simply acted under an old mental model. They believed that because the money was theirs, moving it would be simple. That used to be closer to true. Today, it is less true. The rules have changed quietly. The reporting net is wider. The software is more sensitive. The penalties are larger. The thresholds are lower in real terms. The digital systems are more connected. The incentives of banks and businesses point toward reporting and delaying rather than taking risk. That is the core truth. You can be angry about it, but anger does not move money cleanly. A process does. Before your next large transaction, call the bank, move the money directly. Do not split it to avoid reporting. Use wires when appropriate. Keep records, separate digital accounts, set up trusted contact protections, ask questions before you need answers. If you do those things, you are not trying to beat the system. You are trying to avoid being misunderstood by it. That is the practical difference. And in a world where more decisions are made first by software and only later by humans, being easy to understand is a form of protection. The $10,000 bank rule is not just a number anymore. It is a gateway into a much larger monitoring and compliance structure. The number stayed the same, but the world around it changed. That is why the risk feels sudden, even though it was built slowly over decades. A frozen number met inflation. Old law met new software. Bank caution met legal immunity. Digital convenience met government reporting. Ordinary retirees met a system that no longer sees ordinary behavior as ordinary unless it is documented. That is what changed. And now that you see it, the responsible thing is not to be afraid. It is to act before the next time you need to move a meaningful amount of your own money.